Private Limited.
Welcome back. You're still with us on Markets Today. And this is the fourth headline. Indigo fell 4% after 1.7 crore shares changed hands in a large block deal. Sources have told CNBC-TV18 that promoter Shobha Gangwal is likely to be the seller. Vivek is back with us with the details. Vivek.
Well, absolutely right. So, prior to market open, we had intimated about how, there's likely to be a large block deal. And we had also intimated that, one of the erstwhile promoter stakes would actually come into the market. So, along expected lines, just at market open, you saw 4.4% equity change hands as far as Indigo is concerned. And according to our sources, and we saw the term sheet for this particular, block deal, we understand that Shobha Gangwal is the likely seller in today's block deal. The offer price and the size of the deal was a little over 1875 rupees a share, and the actual size of the deal is over 2900 crore. So what does this mean? This is in continuation for the Feb 22 statement that was being put out by Rakesh Gangwal. He stepped down from the company board and he said that over a 5-year period he would be paring his stake in the company. Also importantly, there is now a 5-month or a 150-day lockup period for further sale of shares. So for another 150 days, this particular promoter entity cannot further sell their shares. So at the end of the December quarter, Shobha Gangwal, Rakesh Gangwal and the Singapore Family Trust held almost 33.78% stake in the company. So this continues to remain an overhang as far as Indigo is concerned.
An overhang indeed, stock down 4.5%. Let's get to the fifth and the final headline for the day. The first stock on our radar is Bata. Now, Bata ended down 2% in trade. The company has decided to set foot in the apparel business to leverage its retail presence. This is even as the company is eyeing sales of 5,000 crore rupees by FY25. Listen in to what the MD and CEO Gunjan Shah had to tell us earlier.
There is a certain amount of sluggishness that you see in the price points which are below 1,000 and especially below 500. And that has seen some amount of sluggishness right from about September onwards. I think it's a cumulative effect of the kind of inflation that consumers have seen overall and the price increases that we have taken to manage this inflation from a footwear perspective. So hopefully that should even out, but that is how we see it right now. Apparel, we had started off on a project on apparel. It's a very attractive category. It's very adjacent to the kind of consumers who walk into our 2,000 odd points of sale. Right. And that has an attractive both in terms of growth as well as in terms of profit pool. We had started a certain pilot pre-COVID. We had kept it on halt. We are now aggressively restarting it. Watch this space. Hopefully, we'll have an update a few months down the line.
Okay, let's move on and get you the other stock which was on our radar. Nestle gained in trade despite a mixed Q3. Revenues missed the mark marginally, but on the other hand, the margins expanded. Mangalam is here with the details. Mangalam.
Well, Nestle's fourth quarter calendar year FY22 calendar 22 numbers were rather better than estimates. In fact, it was an operational beat, and the revenue was mildly below expectations, led by mid-single-digit volume growth as against street expectations of 7 to 8 odd %, and that was perhaps on account of the price hikes that the company would have taken to mitigate the inflationary impact or the pressures that they had, and as a result of which the operational performance did much better. So if you compare it with what the street was anticipating, the revenues that they've posted is close to around 4250 odd crores. The street was working with a number of 4350 odd crores. So there was a 100 crore miss out there, but they more than made up for it with their operational performance. A 977 crore EBITDA versus expectations of 937 crores. That meant that the margins have actually expanded at around 23% versus expectations of 21.4%. And the bottom line was a mild bit, 628 crores versus 618 crores. And mind you, this was despite a 200 basis points decline in gross margins from 56.9% to around 54.9%. How is it that the company did that? Well, one, they took price hikes. Secondly, other expenses as a percentage of sales came down to 22% as well, from around 23.5%. Domestic business grew by about 14%. Exports, which is a smaller part of their business, grew by about 17%. For Nestle, the big trigger going forward will be, scaling up of the pet care business, Purina, that they've engulfed in their own vertical right now a couple of quarters ago, and the other one will be scaling up of their baby food business, which is Gerber. But importantly, for Nestle, it is also relatively less impacted by the slowdown that we're seeing in rural India, because majority of their earnings come in from urban, and for rural itself, they are expanding their distribution. So even if the same store does not buy too much, they are entering more stores. So as a result of which, the rural business grows for them too.
Thank you very much for that. Let's talk a bit about Vodafone Idea. The stock was down 3% in trade. Now, yesterday, the company had a conference call, and for the first time, they have indicated what the annual payout is going to be for Vodafone Idea once all the moratoriums come to an end. Remember, the company has opted for a 4-year moratorium on their spectrum payouts and their AGR payout. Those end in October 2025, which means up until now, the company has been enjoying cash flow relief. But come October 2025 and onwards, the company will have to start making those payouts for the spectrum that they've acquired previously and the AGR payout. And that number is a massive 41,300 crore rupees. 41,300 crore rupees. And to put that number into perspective, it's almost equal to the annual sales of the company. And it's more than twice the kind of EBITDA the company has clocked in the last 4 quarters. According to IFL, the company will have to double its revenues in the next 3 years, which is when the payouts need to start being paid for them to meet these payouts. Otherwise, they're saying it's going to be very challenging. So brokerages clearly are a bit worried. IFL says they're past the first hurdle, but it's a long obstacle course. They have a reduced rating on the stock. Nomura slashed the price down from 8 rupees to 5 rupees, and they're saying the company's reluctance to raise the price of entry-level plans points to a lack of confidence in retaining their subscriber base. And finally, CLSA, their target price too is down to 5 rupees with a sell call on the stock. So that's about Vodafone Idea. For the first time, the company has quantified the payouts once all the moratoriums come to an end, which is 3.5 years from now. And finally, one more stock, Apollo Hospitals, closing higher for the second day in a row. Today, it was up 4% on the back of positive brokerage commentary. Ekta's here with the details. Ekta.
Well, yes, Apollo Hospitals did see follow-on buying. Remember that when it did come out with its Q3 numbers, there were a couple of concerns with regards to Apollo 24/7, that the quarterly investments were the highest ever, but the company did say that the burn rate has peaked for Apollo 24/7. Brokerages seem to be largely positive. Jefferies, for example, has a buy rating. They've raised their target price to 5375. FY24 and FY25 EBITDA estimates move up by around 7% and 8% respectively, according to Jefferies. Citi maintains a buy target price of 5,420. According to them, the company reported good traction across segments, and they believe the company's margin expansion streak will likely continue over the next couple of years. HSBC retained their buy, but they've cut their target price marginally. Tapering losses for 24/7 with a rising GMV will be key catalyst for Apollo Hospitals going forward. Motilal has a buy target price 5,700 rupees. For them, they remain positive on the back of sustained value creation across integrated healthcare services.
Thank you very much for that. With that, it's a wrap on this edition of Markets Today. Thank you for watching.